My first basic question is that the fund you manage is a fund which is investing in private equity. I'm simplifying it for our viewers. These are non-listed companies. We know that public market investing is different and private market investing is different, but I want to hear from you how it is different.
See, the process of private equity is very different from the public markets, right? You have to go through bankers to source deals. You need to have the capability to find good deals, after which you negotiate with the promoters on the rights that are available to you. You have a huge risk at stake, which is the liquidity risk. A private market investor does not have exit options available to them the same way that public market investors do. And then they have the capability to, exercise if they go wrong very easily to get out of an investment, which is not the case in private equity. Private equity is a lot more nuanced, and you're the first time value giver to a private equity investment if this is the first round of capital raise that they're going through. So in that sense, you have to price the asset correctly. You have to understand the vision of the promoter. You have to have the guts to back it. And then going from there, you have to find a successful IPO or an exit in the near future for you to be able to create wealth for your investors. So it's a different ball game. The depth of work has to be significantly higher than the public equities, and due diligence is a very strenuous process. Each deal takes anywhere between 3 to 6 months to close. It's a lot of time, a lot of effort, and it's not as easy.
When you are investing in private equity companies, what are the factors you look at? I mean, in public market, for example, some would say we look at return on capital. Some would say we need to look at the moat in the company. We look at intrinsic value. When you're investing in a small company, which is a private equity business, what are the characters you look at?
So we have a saying at the TriStar Fund, dhanda, banda and valuation. So we look at the business model first, followed by the vision and the execution capability of the promoter, and how we would like to price the asset so that our investors are then able to get an exit which is favorable. So without good business economics and unit economics in place, it is very difficult for a business to succeed in private equity. Without the right promoter who has a capable team to be able to execute their vision, it is going to be a strenuous journey, because a lot of promoters try to do a lot of things and they lose focus. And when they lose focus, it's the investors who lose money.